Greetings, Keith Prather here, and I am with the NCM Powersports Equipment Leading Index for April, for the April report. And so let me go ahead and share this real fast. Here we go. Okay. So we're right now in the middle of obviously all the trade negotiations that are going on and a lot of uncertainty in the marketplace. We've seen the stock market being volatile. But what's interesting is we have had some great signals coming out of the power sports equipment area. So you've got 4.9% growth month over month through March. We saw the index go to 89 points, which is right at all-time highs, which is interesting. It's 6.2% higher year over year. And again, being a leading index, what this is telling us is that the environment looking forward still looks pretty good for all types of power sports. And I think there are a lot of different things going on that are actually promoting it. And some of that is watching this wealth transfer. We're seeing a lot of money flowing down from the baby boomer generation down into younger generations. And with a lot of that cash, they're able to go out and make a lot of purchases. And the power sports sector, among all the NCM sectors, really kind of hits a sweet spot because the total cost of acquisition of most of those items, whether it's the side by sides or motorcycle, whatever it might be, is low enough that they can spend a little bit of that cash that they get and still have a tremendous amount of it left over for a new home or anything else they might want to do. So that's part of it. The other part of it is just that we've got still a good job market, good job environment, and the economy is still doing at least decently well. So we're still getting a good signal here, at least at this level. Now, the other thing that we're watching is the retail sales index. And retail sales index was a little bit better, obviously in March, which is the latest data that we have. So 5.7% higher month over month, but up sharply, 9% year over year. Using just a 3 month moving average to kind of smooth out the highs and lows, it was still 6.2% higher. So there could have been some consumers out there, obviously, that were trying to get ahead of tariff risk. We could have seen that creating some of that 6% spike in March. Some of it is that we just saw some really good tax refunds, and that will help some of that spending. We also know in the farm community that there was about $31 billion that was pumped into the farm community for disaster relief. And we think that there was a little over $3 billion that was going to be allocated for purchases of all types of equipment. The rest of the money, the rest of the 31 billion would have to go to debt repayment for most farmers. But 3 billion would be set aside to improve either their asset-based, operating equipment, tractors, combines, implements, all those things. But the other part of it is a lot of them were going to go out and hinted they were going to go out and pick up side by sides. A lot of ATVs will allow them to go and actually do work on the farm. A lot of them wanted to upgrade that equipment, get into some of the newer technologies. So we think all of that's kind of working together toward creating a little better environment. And then you just got a lot of individuals that are, still wanting to go out and they're biking, they're doing all kinds of different things. And that still seems to be a popular trend. And much like we saw during the pandemic, okay, when we get into very difficult economic environments, one of the things that people like to do is they like to get out and they like to spend money on things that take them away from sort of the daily grind. It's almost a stress relief valve. And so we still see a lot of that taking place. So I'm doing this in all the videos this month. So if you've already heard it, you can fast forward a little bit, but we did some modeling on retail sales. And again, this is 70% of retail spending, or 70% of GDP, I should say, the overall economic growth. And a lot of this obviously is critical and it reflects the industry, in the power sports sector. So we see growth here that looks, at least we're getting a very strong curve, a really good, strong indicator. And this was prior to April 2nd, when the Trump administration announced the reciprocal tariffs that created this surge in anxiety and surge in volatility in the stock market. So prior to that, this was the curve that we had. Then we got the reciprocal tariffs, and you get a lot of fear and trepidation and anxiety, people thinking that the economy is going to fall off a cliff and we're going into recession. And this is the brand new model after that. So this is after we've had nearly a full month of data and inputs into the model. This is the reason why we held this month's report up a little bit longer than normal. We wanted to get the latest data put into the model itself. And this is the furthest that it cooled from. So it went from about $67 billion a month in retail spending down to about $65 billion a month in retail spending. Nothing that looks recessionary, doesn't look like it's dropping off a cliff for now. So that's probably the big takeaway here is that even though there's a tremendous amount of talk of recession risk, we're just not getting those signals, at least right now, from a data perspective. The other thing that's happening is that we think the Federal Reserve is going to step in, and we think the Federal Reserve could do their first quarter point cut, well, the next one, I should say, by June. And that could be followed up by two more between now and the end of the year. And that will really help with short-term borrowing. In the power sports category, especially, that will help with a lot of near-term interest rates and interest rate pressure on consumers. And we know historically that every time the interest rates have started to come down, it's really pumped consumers onto dealer showroom floors. So you could see some more traffic, hopefully, across the entire power sports sector. We know there is a little bit of inflation risk on the horizon. We did see this consolidated inflation measure in Q1 that came in at 3.7%, which is a lot higher than what it had been trending. It had been around 2.7. So we're a little concerned about that. And it's also higher than the Fed's 2% target. But at the same time, energy prices have come down. We're starting to see a little bit of housing price cost increase decreases. There we go. Blah, can't talk. And we're starting to see some other areas where we're seeing inflation impacts start to cool a little bit. Based on that, we still think macro inflation still has the potential to come in fairly moderate, to come in below this 3.7% number, especially as we start striking tariff deals and trade deals. And I think that's going to make a big difference. The 10-year Treasury, which is more long-term borrowing, so I won't spend a lot of time on it here, has less impact on what happens in the power sports sector, except that if it goes below 4% by this summer, a lot of families will go out and refinance their current mortgages. And when they free up hundreds of dollars a month in mortgage payments, a lot of them will go out and they'll use that and they'll go borrow again and they'll go buy, power sports units or they'll go do other things. And so that typically will help fuel some big ticket purchases, and that's what we're watching for. So don't ignore it, but I think it could have an indirect impact and a positive one for what happens in the industry. The job market, watch the job market. There's a little uncertainty in it. Consumer sentiment is still pretty low right now, but on the consumer side of things, when consumers get depressed, typically they go shopping. So that's actually a good sign. Right now, unemployment is stable. It's staying pretty low historically. We've still got good wage growth at 3.8%. So it's still outpacing inflation by a little bit, barely, but a little bit. And, we've got a lot of jobs open still. We have about 1.7 million more than we would normally have. And at least for now, that's a pretty good sign. And then as we get a wave of trade deals, I would circle July. That's what we're all watching. July could be the month where we get a bunch of trade deal announcements between now and then, coupled with hopefully a tax bill that gets signed, which could also create a little bit of corporate tax easing and some other incentives to fuel spending. And that's what the Trump administration is trying to do, is trying to get spending to accelerate by reducing tax burden and tax pressure. And again, depending on what that looks like on the consumer front, you could see a lot of consumers that were worried about that tax bill coming at the end of the year that may dive in and say, okay, I've got relief now. I've got a bill. So that means I've got it extended through 2028 or 2029. And so time to go buy. And I'm going to go ahead and go take some risk. So that's what we're watching for. And again, I think a lot of that could come into this July timeframe. What that sets up then is a pretty good second half of the year. So the first quarter came in almost flat, maybe down just a little bit, maybe by 0.3%. Q2 looks like it's going to come in somewhere around 0.5%, maybe 1% higher. And then the second half of the year, we do get acceleration. Again, we're expecting trade deals. We're expecting tariff risk to come down. We're expecting this tax bill. We're expecting a lot of incentives and a lot of stimulus hitting the economy in the second half of the year, building momentum into the midterms next year. And so with that, we think we come in somewhere around 1.5% this year and then accelerate to maybe 2% next year. There's a lot of hopium buried down in a lot of that. So, there's a lot of things that could happen that could still flip this on its head and make it a little more volatile than expected. But we'll watch for it and hopefully things will turn around and we'll start to see this acceleration, see some of the fear and anxiety go away. But for now, stay hopeful and stay safe.